if you have savings, you should be saving with at least something that compensates you for inflation. Okay, so meaning if it's 7.9, then you should also be saving in an institution or in an entity that gives you the 7.9 at bare minimum. In today's video, I'm going to talk to you about money market funds, which not only give you that 7.9%, but actually something higher in Kenya. Hi guys, how you doing? Welcome to Finance by S. My name is Nguna Esther. I'm going to guide you on exactly what they are, all the way to how to go about joining a money market fund in Kenya, and exactly what to consider before joining a money market fund in Kenya. So let's start with the basics, which are the definitions. So what's a money market fund? And a money market fund is a type of a unit trust that invest these pool funds in conservative money market instruments. What's a unit trust then? A unit trust is a collective investment scheme where investor B, C, and F bring their savings together, and then these pooled funds are invested in any investments in Kenya, whether commodities or real estate or even shares and bonds. Then there are different types of unit trusts depending on now where the pooled funds are invested in. Now, for a unit trust that invests a large proportion of the pooled funds in the bond market, for example, are called bond funds. The ones that invest in the stock market in shares, that is, are called equity funds. And then the ones that balance the risk and invest in the bond market as well as in the equities or shares are called balanced fund. Now, for unit trusts that invest the pooled funds in conservative money market instruments, and these are, by conservative I mean low risk and short term, such as low risk and short term debt. These are called money market funds. So money market funds are a type of a unit trust, meaning these are collective investment scheme, meaning many people invest. It's not just one person investing, it's a lot of people's investments. Okay, so it's a collective investment scheme. That's one that invests these pooled funds in low risk and short term debt, such as treasury bills, commercial papers, fixed deposits, and call deposits with banks. The other definitions include the definitions of parties involved in money market funds, and we have first the investor or the unit holder. The investor is called the unit holder, and then we have where the money goes, and this is the custodian. They hold the assets under management for the money market fund. And then we have a professional fund manager, and this one invests on behalf of the unit holders. Then we have a trustee. A trustee will hold every other party accountable in order to achieve the objectives of the fund. And then we do have the auditors. The auditors usually review financial statements of the fund or of the money market funds in order to ensure that they are reflecting a true and fair view of the performance of the fund. Then we have the regulatory body, which is Capital Markets Authority in this case, which licenses and also regulates money market funds. So you now understand what a money market fund is. Nikikwamsha usiku nikuulize MMF ni nini? Okay, mi si mtiaji hivyo, but you're getting to that point where you're understanding. And now you're wondering, MMFs Kenya ziko mingi, so which one do I settle for? Nikianza kuchagua which one do I go for? Don't worry, because I got you. So reason number one to consider before you actually go for a money market fund, reason number one, as I said, financial performance. You need to ask questions such as who owns the money market fund or who backs the money market fund? How big is the owner of the money market fund? Is it a big corporation in its industry, like a tier 1 bank or a tier 1 insurance company? Because this will guarantee that your investment in that particular MMF will at least grow for a long time. These companies tend to have to be going concerns. You can foresee that they will be there in the next 10 to 20 years, and that's the kind of MMF you want to invest in. Criteria number two is the assets under management, and this basically means the market share of a particular money market fund. And it's a proportion of the funds that have been invested in a particular or with a particular fund manager compared to the total funds invested in all the MMFs in Kenya. And this is usually important to determine, the level of investor confidence in a particular fund manager, because it shows the number of Kenyans that trust this particular fund manager to not only keep their money safe but also grow it. As of June 2022, CIC had the largest at 41.8%, meaning that 41.8% of Kenyans invested in MMFs actually invested in CIC. Criteria 3 is the portfolio of the money market fund. Portfolio is a collection or a group of investments held by a person or an entity. So you definitely want to ask for the fact sheet of a particular money market fund in order to determine, to be able to know where they invest their funds in. A fact sheet shows, all the details of the MMF from when they were founded to where they invest in. And this should be able to give you a clear picture of where they invest their funds in. So whenever you see bonds somewhere or equities, my friend, run to a higher unit trust, like higher meaning a higher risk, a riskier unit trust, which will also in turn have the potential of higher returns, like a bond fund or an equity fund. Essentially, MMFs should be low risks. Criteria number 4, customer service. So you are inquiring about a particular MMF, so you send them an email. How promptly do they reply to that? You want to transact your initial investment. How easy is it for you to open the account and also transact the initial deposit and also top-ups? When you withdraw, how long does it take before you receive your money in the bank? Customer service is very, very important because it determines what you will go through while opening an account with a particular MMF, what you will go through when withdrawing your investment, how often you'll be getting your statements to see how your investment has been performing. On to the last criteria, which is interest rate or yield. Now, I know you're asking, why is interest rate not the first criteria to be considered? Because it's of course very important, but it keeps on changing depending on the market. Okay, so it keeps on changing depending on how these underlying assets are performing, and that's why you will probably see a money market fund offering 10% in January, and then by December it has changed, probably even 8%. And that's why interest rate alone cannot be used to select a proper money market fund, proper in quotes money market fund. It's also very important for me to state that most MMFs state their interest rate net of the management fee. Management fee is a part or a certain percentage of your investment that they deduct in order to cater for their own expenses. So the average is about 2%, with Sanlam at 1.2%. So meaning that 1.2% will be deducted from your investment in order to cater for the expenses of the MMF. That's why you should actually consider also the management fee and go for one with a low or a reasonable rate of management fee. So they deduct this. Most will state their interest rate net of this, meaning they have already taken the gross and then deducted the 2% or 1.2%, and then what they show is what you will get. But also another point is, you as an investor, you are taxed 15% withholding tax from your interest income, just the interest, not the principal, from your interest income. So most MMFs do not indicate their interest rate net of the withholding tax. And that's why unaweza pata, your interest and you're calculating to unapata and what you think you should be getting, and you're like, why is the math not mathing? It's because they've already deducted the 15% and given you your 85%. So from this, you find that you should not go for an MMF offering the highest yield, but you should go for one that has a reasonable yield. To assess the reasonability of their interest rate, most MMFs usually use treasury bills as their benchmark, whereby we have three do I say types? Yeah, types of treasury bills depending on their maturity period. We have the 3-month one, which is the 91-day one. Then we have the 6-month one, 182-day treasury bill, and then we have the full year one, which is the 364-day treasury bill. All these are government short-term debt, and they're usually risk-free because the government will always pay, whether it's through borrowing or taxing you more or printing money, they will always pay. Sorry, look at me saying pray. So they will always pay. And we usually have 3 treasury bills depending on the maturity period. We have one for 3 months, 6 months, and a whole year. The one for 3 months is called the 91-day T-bill, and then 182-day T-bill, and then 364-day T-bill. So most MMfs will use the 91-day T-bill as the lowest, rate of interest they should be offering, and the 364-day one as the highest rate of gross interest they should be offering. So that's how you assess the reasonability of the interest rates being offered by money market funds. So those are the criteria that you should consider before selecting a particular MMF. And guys, now I'm seeing this video will be too long, and I didn't want it to be too long. So in my next video, I show you why you should be joining an MMF as soon as possible, the soonest you can, okay? And also what you need to join and how to join. And I'll also be sharing my top list of the best MMFs in Kenya according to me, so watch out for that. Definitely guys, I'm going to ask you to subscribe. It's a motivation for me to sit here next time, okay? So do subscribe and also put on the notification bell. Thank you so much for watching, and I'll see you in my next video. Bye.